When the news mentions a potential Fed interest rate cut is coming, what exactly does that mean and why should we care? In this video, we will introduce the definition of rate cut and what the impacts will be to everyday individuals. We will also introduce 4 investments that can protect your assets in the wave of rate cut. These investments have the potential to help you achieve financial freedom and break free from the constraints of a traditional 9-to-5 job. The first question is, what is a Fed rate cut and why does it matter? Fed refers to the Federal Reserve, which is the central bank of the U.S. So when the news says the Fed cuts interest rate, means the Federal Reserve has decided to lower the interest rate. This rate is called the federal funds rate. It is the cost for banks to borrow money from each other overnight. This number is considered as the benchmark to determine all other borrowing costs. Now the Fed lowers the interest rate. Then it becomes cheaper for banks to get money. In return, banks can lend money to individuals or businesses at lower interest rates. This can help stimulate spending and investment because loans for cars, houses, and expanding businesses are more affordable than before. The goal is to help the economy grow when it doesn't do well like the current market. For example, in 2021, a car loan might have carried an interest rate of 4% for someone with a decent credit score. Now, this rate is about 8% or higher in 2024. Obviously, the interest rate has doubled. That is actually discouraging people from purchasing new cars. Similarly, people are waiting for the mortgage rate to drop so they can buy houses. It also forces businesses to slow down expansion due to higher borrowing costs. Given that rate cuts are intended to boost the economy, how can we benefit from it? Is there anything we can do to prepare? Absolutely. We will introduce 4 investments that you can do in this rate cut cycle. First, let's start with the most conservative investment. How do you determine if something is valuable? It must be something widely accepted and trusted, like gold. In the past, gold, silver, copper, and iron were the primary metals used in trade, but only gold stood the test of time without corroding or losing its luster. This enduring stability made gold a reliable investment when there weren't many investment opportunities around. Even today, gold is still recognized and valued worldwide. Essentially, this is a trust that has been built over centuries, so the market's confidence in gold's value is still very high. Now we can say gold is a currency of trust. Additionally, gold has very limited supply. So far, we only have 244,000 metric tons of gold existing globally, making it a rare and precious asset. In the last 2 black swan events, 2008 housing crisis and 2020 pandemic, while most assets shrank and stock prices plummeted, gold defied the trend. Instead of losing value, it surged and reached new highs. In the last 2 years, as the Fed continuously raised interest rates, central banks worldwide started printing money endlessly, and investors feared the dollar might become worthless. Yet, throughout this period, the price of gold continued to rise, reinforcing its reputation as a haven in times of economic uncertainty. As we can see when the market is unstable, or even during war times, gold's value often rises, making it a reliable asset to include in our portfolios as a hedge against uncertainty. While no one can accurately predict when the next financial crisis will come, we can always prepare for them. There are different ways to invest in gold. The easiest way is to buy physical gold. Costco is selling gold these days. If that is too risky for you, you can purchase an ETF called SPDR Gold Shares, ticker symbol GLD. This is the same as when you purchase stocks. You can easily buy and sell online. It is a simple and secure way to protect your assets. The second investment is capitalizing on trends in the stock market. This may sound confusing, but it is a straightforward way to build wealth. By riding the wave of a strong market trend, you can potentially turn a modest investment into significant returns, particularly in tech stocks related to AI like Nvidia or Tesla. Although this growth may not happen overnight, it can be achieved within a relatively short time frame. For instance, 10 years ago, Nvidia was trading around 50 cents per share. Today, it is about $110 per share. This is a 220 times increase in just 10 years. So a $10,000 investment 10 years ago would become $2.2 million today. Similarly, Tesla also had 12 times growth in the past 10 years. Why do these companies have huge growth, but not most stocks? Well, that has something to do with productivity improvements. Since the beginning of human history, we are always finding ways to produce more products efficiently, and this trend has never stopped. Now, as we enter the AI era, major players like Microsoft, Google, and Amazon are heavily investing in AI, driving a massive demand for chips. That's why we are seeing all companies producing chips have experienced huge growth in recent years. Companies like Nvidia, Qualcomm, Advanced Micro Devices, and ASML Holdings all did very well. Understanding where future trends are headed allows you to position your investment strategically. Obviously, investment is also involved with risks. So far, AI only brings in very little profit to tech companies. If AI is not profitable later on, tech companies will stop purchasing chips from Nvidia. Then the stock price will plummet. If you think catching the trend is too hard or too risky, we can also utilize the power of compounding. The third investment is compounding. We know Warren Buffett has a net worth of $138 billion today. In fact, most of his wealth was earned after he turned 50. How did he achieve this? One strategy he has been using is compounding, and we can calculate it by the rule of 72. Let's say your investment has a return of 8%. Then it will double in 9 years. How about 12% return? Well, that will take you 6 years to double your money. In the US stock market, there are so many ETFs we can invest in with very low risk. For example, if you don't want to pick individual stocks, there is an ETF called Vanguard Total Stock Market Index Fund ETF shares. The ticker symbol is VTI. This ETF is investing in all the stocks in the US stock market. So, it saves you valuable time to pick the right stocks and still growing your wealth as time goes. In the past 10 years, the return is 10.49% per year. So this will take you 7 years to double the initial investment. If you think VTI is too broad, we can narrow down this to invest in the 500 biggest companies in the market, also called the S&P 500. VOO or SPY are good representatives of the market. In the past 10 years, this ETF brought us 12.82% return per year. This rate would take you about 5.6 years to double your money. The last investment benefit from the rate cut is real estate. With the interest rate hike in the past 2 years, the real estate industry has very little growth. High mortgage rates have kept many potential buyers on the sidelines, which has also negatively impacted commercial real estate. Given that real estate typically operates with a high debt ratio, it is very sensitive to the interest rate change. In a low interest rate environment, real estate companies can reduce their expenses and boost overall profitability. Moreover, low interest rates make mortgages more accessible, encouraging consumers to enter the market. From a broader economic perspective, lower rates offer large real estate firms and banks improved financing conditions, which can drive mergers, acquisitions, and business expansion. Consequently, the real estate sector is well positioned for relief and new growth opportunities in this more favorable interest rate climate. In the upcoming interest rate cut, We can all benefit from it as individuals. The key is to pick the right investment that we are good at. Thanks for watching. Be sure to hit the like and subscribe button for more helpful tips like this. See you in the next video.